You're about to hear my conversation with our Chief Investment Officer, Leslie Marks. We talk all about tariffs, the U.S. fiscal policy, the Big Beautiful Bill, and Canada, and how they all are intertwined. I hope you enjoy. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to Market Exchange, a podcast from Mackenzie Investments. I'm your host, Matthew Schnurr, and I'm delighted to be back with our regular guest, Leslie Marks. Leslie, welcome back.
Thank you so much, Matt.
Why don't we kick off with probably the most timely news that's made the headlines just yesterday, which is an announcement on the U.S.-China deal. I think that general reporting is a little bit skeptical that there's a lot of meat on the bones, but what did you take away from that?
Well, I think that the first takeaway is that, President Trump likes to use the expression, they don't have the cards. And I would say, in my first takeaway here, it looks like they might have at least one card. And that card would be critical minerals. And China did exert its power over the United States in this latest negotiation by virtue of the fact that they basically stopped sending critical minerals to the United States. Now, why is this important? Well, first of all, China controls about 93% of rare earths supply, which critical minerals are a part of. And so when it comes to options, and this is where the having the cards part is important, the US doesn't have a lot of options. Their critical minerals or their magnets specifically, rare earth magnets, are very much integrated into the supply chain in the United States. And this is the supply chain for just slightly important items like cars and electronics and defense items. So, what I think really brought the two sides back to the table was China was putting a lot of pressure on the United States manufacturing companies by what looked like almost like an increase in red tape to export rare earths out of the country. And so it basically wasn't happening. And so that's what was the catalyst to bring both sides back to the table and President Trump to say that they weren't bargaining in good faith. So the good news is fairly quickly, both sides came to the table. There was a sense of urgency. What I would say came out, and when you said not a lot of meat on the bones, what I would say came out of the framework or the agreement was just really more of a truce, a commitment to continue to negotiate into the current reprieve deadline, which is, I believe, sometime in early August, I think August 10th. So that's where we are right now with the US and China. It seems that we have a little bit of a detente here, and things will start to flow a little more freely. And this gives us some time for both parties to continue to negotiate.
Great. I'd love your perspective, just broadening it out from China and talking about tariffs in general. What deals are you optimistic that get done, and where do we stand now, or how would you describe the present situation?
Well, it's been really interesting. I would say that it doesn't appear to be as acute as it was certainly in the April timeframe, and certainly cooler heads have prevailed. But I think the obvious thing to mention is that we're recording today on June 12th. That July 8th deadline is approaching fast and furious, and so we're kind of two-thirds of the way there, and here's what we've seen so far. Number 1, we've seen one trade deal with the UK, and this is a region where there is a trade surplus, so it's not surprising that that one happened first. As we just talked about in your previous question, we've got the trade truce with China, the 90 days. And then we've heard some comments around, being close on a couple of deals, but we really don't have much else. So there's a lot of work to do over the next less than 30 days. So the likelihood of seeing major deals or a lot of deals in that period of time is probably pretty low. But I think that's okay. And I don't think people will panic because what you're starting to see is an indication come out from the key spokespeople in the White House and the president himself that there's a willingness to extend the deadline. I mean, the deadline is sort of not that relevant, only in the sense that it gave, a big number when they put the deadline in place to say, well, we've got 90 days to negotiate. So I think there is a lot of flexibility around that deadline, and what they've been focused on is that if there are countries or regions, in the case of the EU, for example, that are negotiating in good faith and there's good progress in negotiations, that they would be willing to move the deadline. They've also said, I heard today, Treasury Secretary Bessent said that they're very focused on 18 important trading partners. So this idea of 90 trade deals in 90 days is obviously not realistic. And so I do think that you will see, first of all, that deadline float. I think you could see 1 or 2 trade deals, important trade deals, before the deadline. And I also think that comments like, I think it was last week where we saw, from the Commerce Secretary Lutnick, that earlier deals will have better terms. I mean, that sort of indicates that they're trying to put some pressure to conclude on deals, but they're not getting movement to the extent that they would like to see. The last thing I will say on this is, and I've said this before, I'm confident on your podcast, is if I was on the other side of that table, I certainly wouldn't feel pressured to make an agreement long before that July 8th deadline, because they know that the White House wants to show some progress on the trade side. So I do think that the other side of the table in most cases is moving rather slowly. We could talk about Canada, because Canada's been very much quiet, quietly negotiating as well. All of my comments that I just made were actually related to sort of ex Canada.
Right.
And what I would say about Canada is I actually really like what I'm seeing about how the negotiations are taking place, which is very quietly. Not really in the media. We're not seeing a lot of media involvement. And I think when the media gets involved and starts, when both sides start leaking information to the media, then people start to get nervous and anxious, and that can really change the narrative and really change the path of the negotiation, because everyone's a critic, of course. And so there seems to be this mutual agreement to negotiate quickly between our
Yeah.
two countries and to negotiate quietly. And I think that is a real positive. Yesterday, I read that the U.S. ambassador to Canada, Pete Hoekstra, said that there is definitely urgency in the talks between Canada and the United States, which is what we want. And he even went so far as to say that potentially there could be some motivation to have at least that moment or an announcement or a venue at the G7 in Kananaskis,
Wow.
which is coming up very quickly. So I think that some Canadians are feeling disappointed that we're not seeing a stronger message coming out of our government, about the latest tariffs that were announced on steel and aluminum, increasing the tariffs to 50%. But I do think there's method to the madness here, and there is a reason specifically why we're not seeing comments on that front.
Great. Yeah, the G7 is literally just around the corner, a couple of days away. So we'll see
Mhm.
if we hit that deadline. Just to follow up on the conversation between Canada and the U.S., do you think Mexico's a part of that as well, or is it negotiating independently from Mexico?
I think it's very much negotiating bilaterally between Canada and the United States. As you know, and we've all read that Mexico was obviously invited to the G7, and we don't know whether they will attend. So I do think the focus continues to be bilateral, and it's very much this security and economic arrangement between our two countries. And given the importance of security, the importance of the Arctic in those discussions, I do feel that the the ability to negotiate bilaterally will make this move a lot more quickly, and I think that's an advantage for us right now.
Why don't we stick on that comment? I do want to come back to the big, beautiful bill, but I'll ask you in just a moment. But let's talk about Carney's first moves, because I think it sort of comes along to what you were just saying. So his first policy moves being increase in defense spending, some tax cuts, and then trying to cut some red tape and approval timelines. So what do you take from that, and how, I guess, entwined is it in the negotiation with the U.S.?
Well, I think that yes to all of that, and I think it's generally positive. I mean, who wouldn't want tax cuts? Who wouldn't want the policies around breaking down barriers, making it easier to do business in this country? Of course, the one controversial aspect of his policy is related to making Canada an energy superpower. There are some people who don't believe that that is a great strategy for obvious reasons. But when you have something that's so valuable and necessary, such as our natural resources, I think not to take advantage of that as a country, I think would be a mistake in the face of what we are seeing, which is a very quick impact on the change in our relationship with our most important trading partner. And I think although Prime Minister Carney has had a very successful track record in advocating for net zero and green energy and the energy transition. I think it's an and, not an or. I don't think that making Canada an energy superpower is at the expense of all of those objectives, but it is necessary for us as a country. So I also think it should not be lost on people that Prime Minister Carney is leading from a minority government situation, and typically, a minority government doesn't last its full term of 4 years. So I think there is very big interest here in setting himself up for an election, not saying in the near term, but somewhere between, 2 to 4 years, that could put him in a majority government situation, which would make him be able to lead from his perspective with more strength and definition. And so I think that a lot of the policies that you're seeing, his ability to bring parties together to negotiate across provinces to break down barriers will be a strength of his that will be necessary for him to be successful in getting that majority government that he would want to aspire to.
Great. Let's circle back then to the big beautiful bill. Clearly, this has gone through the House, and it's opining. It seems like there's a controversy on it. There's the whole Elon Trump fiasco, which we don't have to touch, of course, but I think it highlights just how contentious this is in certain segments of the governing party. So, what do you think of the big beautiful bill? What do you think of it in its current state, and how likely do you think it is that it remains in its current state without, let's say, significant changes to it?
Well, I've been describing it more as one big beautiful mess because that's sort of how it is landing today.
Hmm.
We know that there was a lot of strong arming to get it through the House first, and that it seems to be gaining more resistance at the Senate level. So I think the idea that this makes it that it passes before Independence Day, before July 4th, is more remote now, but that doesn't mean it doesn't happen. It just means it could take a bit longer. As people have described it, it's an 800-page bill. So, with the people that passed it probably didn't dedicate the time necessary to thoroughly read and understand this bill at that time. Changes were happening fast and furious. And so, I think now with the benefit of more time, people have a better understanding of what the implications are. The Trump administration is also seeing the reaction around the increase in debt, and that sort of speaks to the Trump Elon fallout, which is this is really the center of that. Well, the first part of the disagreement, which
Sure.
deteriorated into a lot of different directions, which we don't need to get into because there's been
Right.
enough ink spilled on that topic. But I think this is really the issue, and it has far-reaching consequences in capital markets, which is what we're really focused on, our listeners and ourselves as investors. And those far-reaching consequences relate to interest rates, the US dollar, and all the implications that that has for the US economy. And so I do think that there is a likelihood that in its current form, it does not make it through the Senate. It won't pass. So therefore, there's another negotiation at hand in order to make some adjustments. Regardless, the end result will likely be lower taxes. And so the bottom line is there is some stimulative aspects to the one big beautiful bill. And we all recall what happened in Trump 1.0. That ended up being very good for the economy and very good for stocks in turn. So I think on balance, it will end up being good for capital markets, good for risk assets, but it's got a bit of a rocky road to get to that point. It's not going to be easy between now and the finish line, and that's what everybody is learning day by day about the one big beautiful bill, which that's why I say it's going to be messy before it gets clean.
And your view on taxes, that's beyond just the extension of the Trump tax 1.0. You're expecting more than that. I'd say, and correct me if you have a different opinion, but the sort of 1.0 extension of those tax cuts into perpetuity is largely expected and priced in. It's this incremental piece that is the debate.
Exactly, exactly. It's the incremental piece, and this is really important because even though there isn't this admission, but there has to be some offset to the tariff side and the impact of tariffs to the economy. So you need to have some stimulus to offset the impact.
Great. Why don't we turn to the Fed? They're in the unenviable position, probably, of setting policy with lots of unknowns on the fiscal side. And I'd love your view on where they stand and what to expect out of them.
I think it's a good segue, and actually, I almost ended on this point, which is the one big beautiful bill is quite stimulative for the economy. What we heard yesterday from maybe it wasn't yesterday in the last couple of days, but yesterday from the vice president, but over the last few days between the president and the vice president, they're basically saying again that Jay Powell needs to be cutting rates and he should be cutting at a 1.0, so a 1% cut. Reality is that right now, if if and when the one big beautiful bill passes, this will actually be quite stimulative, and this is part of what is making the Fed's job so difficult. If you look at things like inflation, yes, inflation has been surprisingly muted. We've seen the latest, May data. But on the other hand, that sort of opens things up for potential to cut interest rates. But the economy has actually been performing okay. When the Fed looks at the current data as they see it, there's no reason to cut interest rates. It's more prospectively, what do they think is going to happen in the future? And a lot of the tariff impact, of course, the worst case scenario has been very much rolled back, but in certain sectors of the economy has had a negative impact. But overall, in aggregate, when you roll everything up, hasn't really been that negative. So they're not seeing the data that supports a rate cut and knowing that we're going to have stimulus on the fiscal side. If they didn't have that piece, then they might be more inclined to cut interest rates. So we're going to hear from the Fed next week. Like most, we don't expect the Fed to cut interest rates. Nobody could sort of create the narrative as to why they would do that at this point in time based on everything that's been said. Right now, it looks like the next cut would be in September. But it's been shifting really every piece of data, and there will be a lot of data between now and September. The consensus view has certainly been shifting. There is a significant part of the economist population that doesn't believe that the Fed will cut at all this year. We do think that we will see 1 to 2 cuts this year. One thing that I think is really interesting, which was a headline that I saw yesterday, was a rumor around, Treasury Secretary Bessent being the next Fed chair to replace Jay Powell when his term comes up in 2026, and we discussed this as a group to have a view on would this be perceived as negative or positive. I think on the positive side, Treasury Secretary Bessent is widely respected, and he's viewed as very much a moderating, voice in the White House. But that is a double-edged sword because if he leaves the White House,
Sure.
remember the Fed is meant to be independent. So all of a sudden you sort of vacate this very measured, even response and voice from the White House and move that into the Federal Reserve. So what happens after that? So that could be potentially a negative. The second potential negative is what I said about the importance of the independence of the Fed, and he's quite a close ally to President Trump. You obviously haven't seen the level of conflict that we've seen with other folks in the White House between the president and Treasury Secretary, and he obviously listens. President Trump very much listens to Secretary Bessent's views. So if he's moving into this role in the Fed, there will be questions around his independence as the chair of the Federal Reserve. So I think that on balance, it's not going to be a big negative depending on who backfills the role as Treasury Secretary. But I think it is moderately negative if this were to come to fruition. I think we have some time for this, but what you will start to see is noise increase around this idea if there is any validity to it.
Interesting. And this is for the replacement for Powell in 26, as opposed to the idea of a shadow Fed that's been floated by some media where they're debating, or is it not that clear cut?
Yeah, no, I think it's more a replacement. Yeah,
Replacement
announced as
for Powell.
the chair of the Fed. Yeah.
Great. Let's stick with the US, talk about the macro backdrop. Give me your view on the three big ones: the CPI, jobs, and economic growth.
Yeah. So I think the biggest observation that we continue to make around the macro backdrop in the United States is the gap between soft data and hard data. So hard data being, the big ones that you mentioned, CPI, jobs data, economic growth. Soft data being more focused on consumer or business sentiment, things like that, propensity to spend. I think this is historically the one of the largest gaps that we've seen in the difference between soft data and hard data. So obviously those will converge in the future. The question is in which direction do they converge? Do people start to feel more optimistic and therefore the soft data improves? Or does the hard data start to roll over? And interestingly enough, we just haven't seen that yet. As I mentioned, the recent CPI data and today PPI data both showed muted trends.
Right.
We'd expected to see some trend of or pricing in of inflation. We did not, or at least price increases. What happened was there were some natural offsets, and we believe that businesses continue to absorb the tariffs for the short term. Now, that's not a long-term strategy, but they can either, utilize their current inventories, therefore they don't need to take price, or they say we're going to absorb for a couple of months. And in my own sort of anecdotal experience in travels, that's certainly what I've seen, which is for now, we are absorbing the impact of tariffs, or companies are just not importing those goods that are highest, that are highly subjected to tariffs. So they're adjusting, but overall, the tariff numbers as they're presented now in aggregate look like about an aggregate tariff level in the 12 to 13% range. And that's quite a big delta on top of the, call it 2% we started the year with. So it is not as bad as it could have been or what we saw in early April, but it's still a big number. And it would be equivalent to one of the ways that I've looked at it is the introduction of a VAT tax, for example. Like all of a sudden, you have this tax that came out of theoretically nowhere. So, so CPI is that's been interesting and I think a little bit surprising. The second area is the jobs data, and the jobs data in the United States has actually been surprisingly quite I don't know if I would call it strong, it's been more muted, but it hasn't
Right.
been terrible,
Mm.
and most people have viewed the jobs data as pretty good in supporting continued economic growth for the country. I mean, of course, we've seen some decline in federal employment due to DOGE and things like that, and in certain sectors like manufacturing, but there's something else that's really important in the labor market, which is happening that I think is of note and that we need to think about as investors. And this is the crackdown that we're seeing on immigration.
Mm.
And today, for the first time, and I mean, this seems so obvious, I sort of surprising, but sometimes things that are said, you sort of shake your head up. But today, the president acknowledged that there was a significant impact on US businesses that rely on foreign workers. And in your travels, I'm sure you can appreciate that that would be primarily in sectors like hospitality or agriculture, where there just aren't enough workers in the United States to fulfill those roles. And many of those roles are filled through the immigrant population. And so he's even talking about a pivot from the strategy. And there's been discussion around people just not showing up for work because they're so afraid of ICE coming into their workplace. So I think this is just another example of where the administration creates what I would describe as shock and awe around a policy and then backs down from it. And I'm not talking about the taco.
Sure.
Trump always
Yeah.
chickens out. I'm not talking about that specifically, but I'm talking about creating some event in order to create action and to instill fear. I'm talking about actually doing this by intent and then recognizing either because they didn't know, which I don't think is the case in this case, or they are responding to a strong lobby from corporations and CEOs, et cetera, around what the real impact has been of a policy. And so that causes an off ramp or a reversal in policy. So I think that's interesting because I do think without this off ramp here, which we don't know what it's going to be, but it'll
Right.
probably come in the next couple of days. You'll see it as a post on Truth Social or something. Um, I think that you could have started to see wage inflation because then you get into that COVID environment where there's competition for workers and the only thing you can compete with is wages. And that's the last thing you want hitting inflation because that becomes very difficult to reverse. We saw how long it took us to unwind from that in 2022, I guess 2023. And as I said, because that takes so long, that would push us right into a 2026 problem. And let's just say that the president, the administration doesn't want to have any of these types of problems heading into the primaries.
Right. Makes a lot of sense. Just before I let you go, I love your quick reaction on Bank of Canada. Their latest meeting, they decided to stay flat. And just wondering, there seems like there's certainly a little bit of an easier scenario than the Fed has, and maybe directionally cuts, but love your take on it.
I think you're right that the Bank of Canada has a clearer path than the Fed. Unfortunately, it's a bad path, which is
Right.
that they're responding to weakness in economic growth. And as Canadians, course, it's not the situation that we want to be in, so hopefully it won't be long term, and we know what the catalyst has been. I mean, most of this has really come through the weakness that we've seen as a result of the trade war that we're in with our most important trading partner. I thought what was really interesting in the Bank of Canada press release last week was the first line, and I'll read it to you, said that they've decided to keep their policy rate at
Yep. Sure.
2.75%. The second line said, "The US administration has continued to increase and decrease various tariffs." And that just says it all for me. The
Totally.
first thing you say is the most important thing that informed your decision to increase and decrease various tariffs. And, then they go on to say that negotiations are ongoing, tariffs are well above the levels at the beginning of 2025, and the threat of new trade actions still exist. Thus, uncertainty remains high. So, the Canadian economy could certainly withstand another rate cut. It could be easily justified, but I think the level of uncertainty is still so high for Canada that the Bank of Canada decided that they wanted to keep their powder for later in the year. And there was an acknowledgement that a lot of the strength that we've been seeing in the global economy and frankly, Canada, not that Canada's been so strong, but it's certainly been better than we expected it to be at this stage, is primarily due to the temporary surge in activity
Right.
for people to get ahead of the tariffs. Canada's economic growth number came in at 2.2%. And, um, if you just sort of didn't know about anything to do with this trade war and looked at the Canadian economy, you would say that with muted inflation and 2.2% economic growth in the first quarter, that's kind of a Goldilocks scenario. Having said that, there is one caveat, and it's a big one, and it comes from a few of the other things that are lurking in the background. It goes back to this soft data. Business confidence is plummeting. I think we're kind of at levels that we haven't seen since the pandemic. Consumer confidence is at its lowest levels ever. The jobs data, back to hard data, Canadian unemployment has tipped over 7% in our most recent unemployment announcement. And I want to remind our listeners this is from a low in 2022 of 4.8%. So although the uptick was only zero point 0.2, we continue to be on this steady trajectory of higher unemployment. And most notably in unemployment, and you've started to see more press attention to it, is youth unemployment, which is in the 14% range. Now, of course, that the youth unemployment is the age group of 15 to 24 years, so it includes students, but in that age range, that also includes new graduates. So this is really important when it comes to the Canadian economy and as sort of foreshadowing darker things to come, because that's kind of the first thing you stop hiring is adding through new entrants into the workforce. So all is not so grand in Canada, but there are lots of reasons to feel optimistic about the future, as we've talked about today, around the very constructive policies that we think are going to happen in Canada with our new prime minister, a potential announcement of a trade deal, and not the renegotiation of USMCA, as you asked about, whether this was trilateral or bilateral, but certainly that economic and security agreement with the United States, the announcement of the new bill that Prime Minister Carney introduced to bring down the economic barriers across the provinces. So there's lots of good things happening. It's just where we are today is in a bit of a tough spot. And the Bank of Canada does have the ability to support the Canadian economy in the future, and we expect that they will.
Let's end it on a bit of an optimistic note there. So thanks very much, Leslie, for coming on and sharing your views.
Thanks for having me once again, Matt.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may be associated with mutual fund investments. Please read the fund facts and prospectus before investing. The indicated rates of returns are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.